One.
Well, September was really bad, and October wasn't as bad. Starting a new month here, the year-end rally, if it's going to start, it better start soon. Two up days in a row. We got Fed speak. What's Powell going to say? Can we make it three in a row? Boy, I haven't seen a 3-day winning streak in a long time. Earnings aren't helping out. Tommy Lackey at 8:35 to give us his look on the markets. It's Wednesday. It's pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elkanin
This is a volatile puppy here, isn't it?
and Dennis Dick,
I'm bidding a penny. I'd buy that stock for a penny.
with everything you need to start your trading day.
Okay, we're starting out in the red. 16 handles, 41.96 and a quarter. Just couldn't catch a bid off that opening bell. The buck is up. That's not helping things. That's up 25 cents, 106.75. Bonds back down a half a point, clinging, trying to get it back above 109. Crude bounces back up a buck 76 at 82.79. Gold in the red by a buck 80 at 19.92.50. Silver in the red by 19 cents at 22.76. And Bitcoin still holding up near 35K. It's down $135 at 34,770. I'm going to bring in Triple D here. And Triple D, if I was doing an over under on the trick or treaters last night, based on the size of the bag of the candy I bought, oh boy, it was an under. We got snow here yesterday. Did you
Snow
get?
here right now. I have snow on the ground.
Yeah.
Snow on the ground. Like just a dusting, but the ground has snow all over it. A dusting here. Welcome to Canada.
Well, Michigan's got it too, but yeah, we just didn't have many trick or treaters. So the ones that came
Not a lot here
were,
either.
were rewarded heavily. And I don't know. I'm going to have Lisa take that. We got one of those Costco bags. We have to take it to work. So let's talk the markets. And man, had two up days. It
Yeah.
was nice. We're starting a day in the red. Really, I mean, maybe AMD earnings, no specific catalyst. What what's Powell gonna say, or he's gonna say nothing, and the market's gonna go crazy anyways?
Um, it's very difficult. I think he's probably still going to just stick with the same tone that he's stuck with. That we're data dependent. We're still looking at data coming in. Hawkish pause, I think, is really what the
Yeah,
tone
I
is. The
think so too.
hawkish pause. Probably the story stays the same. If he mentions like the long-term rates, if he mentions, that's doing some of his work, that would be interpreted as a positive. Bring in Money Mitch here. What time does he speak? Because I don't know the time that he's speaking, Money Mitch. Do you know what time it
He
is?
always speaks, man. Come on, Dennis. You know all this.
He speaks all over the place.
So
Is
what
it 2
always
o'clock?
happens is 2 o'clock is the PDF release, right? The
Okay.
report release, right?
Yeah.
That's what you're gonna catch. That's the prepared
And
statement.
he's
That's
coming
what
on at like 2:30.
That's what when he comes on at 2:30 and he reads that statement, that's literally
Yeah.
what he reads. So if you want to get it at 2 p.m., just read that. Then after, of course, is the fireworks, 2:30. That's when we get his prepared speech. And then the Q&A is what we'll all be listening to see if we see a change in tone. A lot of people are expecting to see more of a dovish tone in the report. But then when he gets to the Q&A, he starts to be a little bit more hawkish. So that's where you got to be careful. Dennis, I know that you're a little bit better than, and I also say it, better than I at trading something like this. And a lot of times there's fake outs. So how do you kind of approach these days?
You fade everything. It's the way this market has been. It's been the fade trade. So like I know I keep sounding like a broken record in the last 6 months, but it's just the type of momentum the market we're in. Contrarians have done very well. Like if you're getting chopped up and you're not figuring out why I'm getting chopped up, it's probably because you're doing most of your trades backwards, looking for breakouts, looking for breakdowns, looking for, like follow through. The follow through hasn't been there in most stocks here. To the downside, it has, but most retail traders don't short stocks. So, but if you're looking like, okay, well, here's the turnaround. Finally, I'm going to buy some stocks here. And then boom, there's stocks down 5% the next week. And you're like, well, why didn't that work? Because we're not in 2020 anymore. We're not in a momentum market. We're in a contrarian market. Why is Jim Cramer wrong continuously? Because we're in a contrarian market. He's a momentum trader. He did very well, Jim Cramer, through 2020. He was like on this. He was on that. And obviously he mentioned a stock and would go up 10% just because we were in 2020. We were in, the fairy tale world that we were in at that time in the stock market. Those days are gone. It's contrarian. So how do I play the Fed stuff? It's all about just fading moves. You get the big rep, fade it. Get the big dip, fade it. That's usually how you're playing this. There's very little follow through in this market. Sorry for the stuffiness. I'm still fighting a little bit of cold.
That new Dell computer I got, right?
Yeah.
The new laptop.
Are you fading that too?
No. I get the Fed statement at I get everything at 158 at the
that's what it is.
Dude, you got to get a Dell.
Yeah,
ahead of everything.
There's another
I
thing
have
too.
everything there, and I know where to put my orders and everything. You're throwing darts at the wall when you're trading during these kind of things. I mean, there's 30, 40, 56 rip handles. If you have targets and you have specific entry points that you want to get in the market, then put them out there and man up and get taken out or buy. If you're going to try and look at what he's saying and how he answers a question and point and click and do something, then you're doing it wrong. You got to wait to see how everything shakes out at the end of the day. There's no secret formula. He could ask one question and it turns one way, and then he'll use a second sentence and he'll say it another way. What you have to look at is the market has been under selling pressure for the last couple months. Once again, it looks like maybe we have a low in place, but what have we seen over the last 3 months? We get a little bit of a breath, a little,
and then they turn around
and then they
again.
slam it back down.
Yeah.
So, I mean, on a quarterly basis, we're negative. On a weekly and daily basis, we're a little bit positive, but hardly out of the market. I mean, we're hardly out of the woods on this, and he's not.
Well, TLT hasn't rallied at all, and we've been saying that there's no reason to buy stocks until we start to see a sustained rally in the TLT. It's consolidated. I think our guest yesterday, Derek, made some fantastic points. Above 85.5 on the TLT, you start looking at stocks. Below 82 on the TLT, and you start thinking about selling more stocks. So, I mean, let the TLT dictate the path we're going to take here because we're just in a consolidation range for 5-6 days. It is productive. There is hope here for the bulls where there wasn't much hope, I felt like a month ago. I feel like I'm not as bearish as I was.
What about on Friday? I mean, come on.
It was an ugly day for the market, but then they turn around on Monday and they just buy the stocks. So was it Friday? I'm losing track of days. Friday was the down day.
Friday we made the low for the week
and they turn
the low
around.
close for the week.
Yeah.
Yep.
Yeah, watch out. We'll see what happens in the TLT. But I have the question of the day here. Has the market priced in a downturn? What do you think about that?
Yes. So depends on what you're looking at. The S&P maybe not. The IWM absolutely. I mean, you can look at some of these stocks that have a lot of debt. They've absolutely been crushed. I mean, the IWM, we can say it's off 18% in the last couple of months, but you got to go further back. Let's go to that high at 244 to 163. I mean, this isn't a stock. It's 2,000 stocks. So 163 off the 264 is what? 80 points off the 240. We're about 33% off the all-time high in the IWM. 33%. That's no longer a correction, folks. That's a full bear market. 20% down from the highs of bear market. It's a full bear market from the highs of 2021 in the IWM. It's been in a bear market for 2 years. The S&P hasn't tasted a bear market here in a very long time because it continues to hold up because of the Magnificent Seven. And maybe that continues to be the case. But, I mean, there's a lot of bad news priced into a lot of stocks. And we're going to go into some of those individual stocks here today. And you are seeing a relief rally in a few stocks that didn't report great earnings, but they're like just seller exhaustion. And I tweeted that yesterday. I think you're going to start seeing some seller exhaustion in certain stocks because some stocks are down 50% in the last 3 months. I mean, is it warranted? I don't know. Maybe if these companies are going bankrupt, and maybe some of them are, maybe it is warranted. But, you know, at a certain point in time, sellers just get tired of selling.
How's your bankrupt stock? What's that? FNC? The one you mentioned the other day? The
consultant company.
Oh, FCN.
FCN.
That's going to profit from the bankruptcies. It's nobody paying attention to that play at all here, but it's just interesting, you know, that is a company we are going to get. I will say, and it's not even a hard prediction. In 2024, we are going to get a lot of companies going bankrupt, companies that were darling stocks, not just like individual private companies, stocks going bankrupt. WeWork, for instance, WE. Give us this news, Mitch. I know we're going off the table here, but we just,
man.
Joel took us off the table when he mentioned FCN. WeWork, once upon a time, the market cap on this thing, I believe, was upwards of 40 or 50 billion dollars. Just insanity. They Wall Street Journal reporting that they are going to go bankrupt here, that they're looking to go bankrupt next week.
And where's WeWork in? What space?
Office buildings and stuff, which
commercial
is just
real estate, baby.
COVID killed it.
Perhaps the worst timing to go into commercial real estate of all time. So yeah, you can't make a.
Is the writing on the wall here, and are they saying anything? I think this just goes to show you guys. This company at one point was a darling. Sorry for my camera. Camera's having some issues today.
Okay.
But definitely it was a darling at one point. I mean, people really liked this stock and people were using WeWorks, but not like they used to anymore. I mean, people would just, if they want to have an office, they're probably just setting up office at home versus paying for going into a WeWork. And they just can't sell them like they used to.
That guy was shady from the beginning, wasn't he?
All-time high, $598. At that point in time, I had a $47 billion market cap. That money is all gone. Whoosh, see you later. Some real money put in. Like, there's some real investors who actually invested in this in 2021 and are losing some of that money. Again, not all of it was just, obviously the market made, billions and billions of dollars for stocks, and then the markets take it away. But I mean, that is gone now. The market cap thinks 110 million. Apparently going bankrupt. This is going to be the story for a lot of those 2021 darlings, the ones that are all trading at 50 cents, 60 cents. A lot of these stocks are going off the board worthless.
ADP, a number in 2 minutes, says Jeff Kenzie.
Oh, crap.
So, we'll keep
ADP expected at 150,000. And jobs numbers haven't really moved the market at all lately. We'll see if this changes.
What's unemployment going up? When are we going to 5, 6, 7% unemployment?
Well, ask Jerome Powell. I'm sure he'll mention it today, Joel. So we got to get you to DC so you can ask that question.
But these are good questions to ask because the stats, the data, to Ryan Dietrich's points, have still been pretty good. Yet you see IWM 33% off the highs, and it's not just those 2,000 stocks. The stocks outside there too. I mean, again, when you get away from the Magnificent Seven, even looking at the RSP, which is the equal weighted S&P, it's down a lot more this year than, like, even in the last few months than the SPY. It's held up. I mean, on the year, I believe the RSP is down. I believe it's down on the year. So I mean, that's just telling you there's been a lot of stocks in the S&P. It's a better indicator of the overall market. It has not been a great year for stocks if you're outside the Magnificent Seven. We'll say that.
How about AMD? Traded down 70 cents, and Dennis talked about buying the dip. Mitch, give us the report.
EPS here at 70 cents, 68 cents was the estimate. Sales of 5.8 billion versus a 5.695 billion estimate. So a beat and a beat there. Gross margins at 51% versus 50% year over year. And they stated on their call, in the fourth quarter, we expect to see strong growth in data center and continued momentum in client, partially offset by lower sales in the gaming segment and additional softening of demand in the embedded markets. If you look at the data center revenue, that was at 1.6 billion, flat year over year. Client segment revenue at 1.5 billion. That was actually up 42% year over year. And their embedded segment revenues at 1.2 billion, down 5% year over year. So two of their major areas at down, if not flat. And the biggest boost, of course, coming from that client segment area.
I mean, the quarter wasn't great, actually. And
no, it really wasn't.
The stock got hit, probably rightfully so. I still have the half-size position in AMD and my kids are ESP. Part of me has thought about reloading the stock that I sold because this is about the area that I originally bought it at. But then the other part of me keeps saying recession coming and stay away, and the valuation's still not that cheap on this stock. So
you got
I'm on the fence on this.
You got one guy on each shoulder. Like
yeah. All the time. All the time. You got, this guy over here saying, "Oh my gosh, you're gonna miss it, and you're too much cash," and this guy saying, "Shut your mouth, because we're going into a recession. We're gonna get all these stocks a lot cheaper." These two guys fight all the time. All the time.
But technically, I'll just give the setup. You had the dip, you had the rip. There's a nice area in the lower 93 handle, and it got there. That was a low that you had from last week. So there's your support. I mean, you got to respect that, especially since you're $3.5, $4 off it. And then on the upside, I mean, it kind of feels like when Lisa Sue comes on CNBC and says something positive, then it's going to go unchanged, and we'll see if it can stay unchanged on the day. I mean, so far they bought the dip in this one. S&Ps are rallying. Looks okay to me. I'd say, look at that close. That's an important number. See if you can clear that. And if you can clear the close, I think you got some room on the upside.
It was a productive tape for it ahead of the earnings yesterday.
Yes.
It made a new low, and then had a key reversal up to the upside. So you have people who are short this probably saying, oh, crap.
Scratching their head.
Yeah, and they want to bring it in, and they're like nervous now because it's not going down on this report. So, and it did hold the 93.11 low from 5 days ago. So that's all the good news. Bad news is it wasn't a great quarter, and the valuation still not that cheap. So I sit on the fence on this one, probably not making any more moves in AMD. Like I said, I have a half-size position. My kids are ESP, which is going to remain there.
One more comment here. Like if you're on
go.
the trading desk right now and, someone had a big short position and then they're like, oh, I should have bought it at 94.5, 95. You'd be saying, don't put the bids out there. Let it breathe. Let it breathe. Let the sellers come in, and then they end up chasing it. So you're far off that pre-market low. Spoo's holding in there. It's not going to be so easy to pick a bottom if it goes into reverse.
Sorry about my camera today, guys. I don't know what's going on, probably
That's
battery issues, but I'll keep trying to reset it here. At least you guys can hear me clearly. That should happen there. Let's move to the disaster stock of the day, and definitely a disaster stock, Paycom Software, guys. Q3 EPS at $1.77, beat the $1.61 estimate. Sales at $406.3 million, missed the $411.18 million estimate. And here is when things get really rough, is when they see their Q4 revenue at $420 million to $425 million versus a $452.27 million
My
estimate.
dyslexia is kicking in here.
PAYC, Joel.
PAYC. So
Joel doesn't
easy.
leave the S&P 500. If it's like not in the S&P,
why would you? Why do you
components.
even want to have a stock like that on your screen?
It's probably true. I mean, if you just continue to invest in the S&P top 10 components, you're outperforming the market. So you're probably right, Joel. It's probably the thing to do is stop looking at everything else and just buy the top 10 components of the S&P to probably outperform the market. I mean, that's what's happened. The S&P continues to be resilient. We continue to complain how it doesn't show what's really going on in stocks, which is true. But maybe it's just the case that maybe that's where we should be invested, is just the S&P, because they get the crap out of there. And the way it's weighted is the strongest stocks always are worth the most. So maybe it is the index tone.
Now, one thing I wanted to show on PayC is how wrong analysts can have it sometimes. I've been talking about how I think the analysts have it completely wrong on NVIDIA. Well, look at this PayC. And I'm pulling this from, of course, Benzinga Pro. Look at this, guys. Just before this, right, on the 24th, Citigroup with a buy and 50 rating or 360 rating? Yeah, 360s. Look at these, guys. Below that, 427, 356, 400. This is the problem, I think, a lot of the times when we listen too much to the analysts and thinking that they know what's going on underneath the hood. And you can see it. They don't know anything here.
No, they don't know anything. Mitch, you're absolutely correct. They don't know anything. Half of them are lemmings. There's some smart ones. Don't kid yourself. You cherry pick the smart ones out and you can follow them to a certain extent. But all they are is commentary that moves stocks. The reason that we listen to analysts as traders is that they move price. So you have to respect it. Upgrades and downgrades undoubtedly move the price for the day. So as a day trader, you absolutely have to pay attention to the ratings. As a long-term investor, I think you ignore it too. I think as a long-term investor, if your time horizon is 10 years and you don't care what the stock does over the next 10 days or 10 months, if you're 10 years, you don't have to listen to any of this stuff. You don't have to listen to any of the analysts, none of that stuff. Unfortunately for me, I make all of my money day trading. So unfortunately for me, I do have to listen to the analysts, and that's where I'm at, is like I have to not follow what they do. I typically, a lot of times I'm even fading, but I have to know, like what I say is, I look at a stock, Goldman Sachs upgrades a stock, depends on what the stock is, probably worth 3 or 4% the upgrade. It's only up 1, I'm buying it. If it's up 5 or 6, I might be shorting it. That's statistical arbitrage. I trade that stuff. When the ratings aren't being priced in enough, I buy them. When they're being priced in too much, I short them. Now, those are trading strategies, not investing strategies. But to your point, Mitch, you're a long-term investor, ignore the ratings. That would be my advice if you're a long-term investor.
Wow. 153, down $92, down 37%. I would give you a level where I would buy it. 147.39. That was
You're going to buy PAYC?
at 147.39. I don't think it's going to get there. I mean, that's the next monthly low, just hanging out on the pre-market low. So you keep crushing it. You're going to have a big flush off the open, right? Because sell stops in there and everything. So I'll just give you the monthly low. 147.39 for February of 28. I don't care about anything else.
This kind of move makes me not want to. This makes me want to sell every stock in my long-term portfolio. When you see a stock going down 38% in one day, because let's give it perspective here. Let's just give it perspective. PAYC. Go back to those numbers here, Money Mitch. You can show them on the screen if you want.
Was it that bad of a report?
Exactly. This is my point here. So they lowered. So they beat on the top. They missed on the sales. They missed by $5 million on 411 million. So they missed by 1% on the sales. And they missed by, they're lowering guidance, which you never want to see lower, but they lowered sales guidance by what? 3%. They lowered, that's 23. And Q4 guidance, sales guidance, they lowered by about 5%. So they knocked the stock down 38%. Welcome to this market that they slam stocks first and ask questions later. Is this an overshoot? For sure. Does that mean it bounces back? Not necessarily, because that's what this market does. It punishes stocks severely when you miss earnings and when you miss guidance. So the guidance actually isn't great here. It should be down. Should the stock be down 38%? I'm shocked that it's down that much, but that's par for the course. There's a stock that goes down 25% on earnings every single day. And the one that goes up 20% on earnings eventually starts to go back down. That's why I've said this play has been the play through this earnings season, just to be short every single stock in earnings. Because on this one, you make 38%. And on the other one that's up 6-7%, if you look back at it 3 days later, it starts to leak back. I think if you were playing that strategy where you were short every single stock, every single one, it didn't matter what it was in the earnings this quarter, I bet you made a lot of money.
Estee Lauder Q1 adjusted EPS at 11 cents versus a loss of 20-cent estimate. Net sales of 3.52 billion versus a 3.529 billion estimate. They do see Q2 net sales down 9 to 11% and see adjusted EBITDA down 60 to 66% on a constant currency basis. Estee Lauder sees fiscal year reported net sales down 2% to up 1% and see adjusted EPS down 25 to 33% on a constant currency basis.
Okay, so that's a serious down. EPS down 25 to 33%.
Yeah,
that sounds
really
serious.
Down. And this is expected in the next quarter.
33% less money last year. That deserves to be down 15% when you see that. You got one lowering guidance by 5%. You got another one saying EPS could be down 25 to 33%. That's serious, folks. So that's more warranted. I would say this sell-off is more warranted than PAYC. Again, I'm not saying go out and buy PAYC. It's just this market punishes and asks questions later. But this Estee Lauder being down 15%, doesn't it feel a little more warranted to you, Joel, when they say the EPS could possibly be down as much as 33%, that the stock would fall 15%?
I mean, have women stopped wearing makeup?
Yes. No, for real.
They just
people don't go out of the house as much.
I mean, look at this. Look at Ulta. Look at Ulta's holding up great. I mean, Ulta looks like the champ. Look, I didn't.
And it's still down significantly.
Yeah, I didn't know that. What's the other one? Elf. What happened to Elf yesterday? Did they have earnings? I mean, that thing got absolutely
I'll tell you what happened to Elf yesterday.
Money Mitch has the report.
So what happened there on Elf yesterday is there was an unconfirmed Jefferies U.S. cosmetic note that was going around, and that was suggesting slower growth from 50 to 45%, and unit growth slowed down from 35% to 32%. And you can see this also affected Ulta. I've been thinking about getting Ulta, and there's even analyst ratings putting a strong buy on Ulta, and I think that's just based on seasonality. but I think they have it wrong here. And I have it wrong too, because I'm looking at old Tom like, man, will this get moving for the holiday season? But no move yet.
And
I think people are
Jeffries,
wearing makeup less. I think people are, caring about their appearance less than they used to be, because I think there's people not leaving the house as much. But I just think it's like this YOLO. It's like, well, this is who I am, and accept me
yeah,
for
I
who I
agree.
am. It's just a change in human nature.
I
Like
think so
I believe
too.
that. There's still people who wear makeup. There's still lots of people who wear makeup, but it's not like it was 20 years ago where you don't leave the house without putting up your makeup if you're a woman. I mean, it's changed. Stuff has changed, and that's not good news for Estee Lauder. Elf Beauty's trying to find its way. It's been the new, but again, all these stocks are now coming off. Again, if you take off the S&P blinders, here's Elf Beauty, which is best of breed, has been best of breed, quietly off 50 points from the highs on $140. You're talking about down 33% as well, 35% from the highs. There are significant sell-offs here in a lot of stocks. Maybe it was unwarranted. Maybe it shouldn't be ever been that high, which a lot of these stocks probably shouldn't have been. But if you think we haven't priced in some major bad news in this market, you got to look outside the S&P 500, because the bears have run rampant in a lot of stocks.
Jeffries, boy, I mean, we've followed that firm for a long time, but I mean, they're moving up the old rankings there. I mean, they're that's a very, very influential move. And then you have the move in that yesterday, and then you get the Estee Lauder news. I mean, that's some pretty good timing over there by Jeffries. Well, based on the makeup budget for pre-market prep, we we should have never been buying here. We've been shorting these stocks the whole time. But I agree, Dennis. I think it's a generational thing. I mean,
I think so too.
COVID was like, okay, what do I need makeup for? And then, all these women are realizing, you know what? I look good without makeup, and
Yeah,
and not going
I think
back
they
to
do too. I think lots of women look great
I
without
know.
makeup.
You can be careful saying that, Dennis, because if you get, you don't ever want to say that. Like, oh, you look better without makeup. They'll be like, well, you don't say that.
No, I look
Well,
good with
let's just
makeup, and
say
then
there's
you're
a
in
reason
trouble.
why the camera's not working right now. Let's keep going.
Yeah,
Mitch.
Mitch is going in
Mitch
like
says I
this,
look
like-
better not on camera.
Mitch is like this. He's like,
I'm fixing myself up, guys, right now. Just leave me alone.
don't
Mitch
even
is getting
know.
himself
All right,
fixed
let's
up.
get to
I
First
really
Solar.
care about my appearance. I got the haircut and everything the other day.
Hey,
so.
guys,
Holy-
let's get the panels up here. First Solar, and is this a short opportunity? I'll just ask the question out there. I think it is, but what do you guys think in the chat? First Solar adjusted EPS at $2.50 here. Net sales at 801 million versus 894.12 million. That was the estimate. First Solar raised, though, their EPS guidance. That's what helped them out here, from $7 and $8 now to $7.20 and $8 still on the high end. So they just raised the low end about 20 cents there. Does this deserve the lift that it got? I don't think so.
Maybe not, but First Solar has been best of breed, and it has been punished severely off of other companies' failures, meaning
It has,
ENPH
yep.
and SEDG. Like First Solar was holding up well all the way. They come out and they raise their guidance. I mean, what in the hell is ENPH and SEDG doing wrong? Because that is unbelievable. And again, they're different business models, so they're different, so maybe that's just, they've got a superior business model. But after this quarter and seeing this guidance raise, after ENPH, if we go back to the ENPH earnings, cut guidance like an SEDG. The SEDG one was even more brutal. Both
Yeah,
of them
that
were
was
brutal.
brutal, man.
Hey,
Like
we're
the
rallying.
SEDG,
What's
I'm
going
going
on?
back
Wait,
to the
hold
pro.
on. We got a rally going on here. Was
Oh,
there an
good. I like
8:30 number
rallies.
we were sleeping on?
I'll take
No,
a look in here.
treasuries to sell 48 billion in 3-year notes. So treasuries.
Treasury
they were
has the
thinking they're going to
TLT
back
moving.
TLT
they'll
just
sell
ripped,
80
folks.
billion.
Okay.
There you go. That TLT just made a big move. And if you look on the daily levels, those are actually important levels. Support right underneath it
Now
around
we got to
the
pay
83.
attention to this 8:30 budgetary number.
Everything.
Oh
Pay
my
attention to
Lord!
all
Look
of
at
it.
that.
They're trying to
Holy
save the
man.
Ackman low, man.
Yeah.
They're trying to save that Ackman
Holy,
low.
I was worried about the 815 number, and I got run over on the other number. TLT just ripped higher on this,
Ripped.
folks. That is
Yeah.
good news for the IWM. Remember TLT,
So they weren't
IWM
selling
linked at
as
the
much
hips.
as they thought they were. I did reach out to Bill, and I did send him the clip. I just don't know if you calling them Billy Boy was really something that. But I asked him
Billy
to come on.
boy, Billy boy.
Yeah, Wow, what a man, a 3-day winning streak. But you got Powell. Powell is gonna, bang,
How the market.
yeah.
Billy,
I'm gonna
Billy
say
Boy in the
overall,
chat, just wanted to state because he wanted to say that this was ADP. ADP actually came in really light, 113,000 versus 150,000. But this is moving more off of that mention that Dennis just mentioned.
this is the
Hey,
Treasury stuff.
Yeah, thank you.
It was
I just
coming.
wanted to
I saw
correct
it on
that.
the calendar. I saw the 8:30 stuff. Treasury, we'll steal off CNBC because they always steal off us. Treasury to continue gradually increasing coupon auction sizes for at least one more quarter. Treasury to boost 2 to 5 years
More
notes, 1 7
debt.
to 30 years notes.
Yay.
Yeah,
It probably
there you
was.
go.
It
More
probably wasn't as much as you
debt.
thought. I want to address something here real quick.
Yeah,
In the
what's up?
chat, Ben K is saying, "What is the Ackman low you're referring to?" So, Dennis,
In the Treasuries.
Dennis, what? Yeah, I think you're the
Did it
one
get
that
breached?
No,
I don't think it ever got breached.
what day was
What's
it? Do
his
you have the day that
price?
he covered?
When
Uh,
Ackman said, I've covered
he
my
was
bond
short
shorts.
bonds. He
He
went
was short
short
bonds, and he said, I
bonds.
covered my bond shorts, and that's the day the TLT turned around and ripped.
I
I
think it was
think it
this
was just
day.
back. I think it was on October 23rd.
I agree. I agree.
And
I
we have
agree.
not breached that low. So we've been saying that the TLT has potentially put in this Ackman bottom we've been joking about here. And I'm just going to say on an overall market discussion before we bring in Tommy Lackey is that we have come down so far on so many stocks. The TLT is what matters here now. Above 85.5, you got to start looking to buy stocks. So I think let's keep an eye on the TLT. It's in the middle of the range, so you don't have to make a decision here yet. But I do think that we set up well for seasonality. We have been crushed on so many different stocks. I think you have seller exhaustion on some of this IWM. IWMs have major long-term support. I'm not saying this is the bottom, but I think it's been too easy on the shorts. And I do think we're getting back into this mentality here where people are starting to think about shorting stocks on every rip, and that's not going to work. So I do think that we've got to start thinking about, not being as bearish as we were a week ago. Can we grab Tommy and see what Tommy's thinking? Because he's the one that knows this market, man. He's the one that called. He called the strong first half and the weak second half. Tommy Lackey does have a crystal ball. Get Tommy Lackey here, and I'm following what Tommy says.
All right, let me pull this chat comment down, and let's get to our guest out there. You guys smash that like. Let's get it going here.
Tommy Lackey Jr., Relativity Capital Advisors. I mean, I don't know if you could get any more of a build-up on an intro than that, Tommy. So we don't want to put too much pressure. Triple D just comes with the pressure, but
I did.
First,
I almost just hung up.
I almost just hung up when I said that. He's like, I can't live up to that. Exactly, I want to know that right. Tommy Lackey crystal ball here, because we give a lot of guest props, but I mean, you got this right. You came on in like, I think it was December or January, and said you saw that we could see, a strong first half, and you thought maybe a weaker second half, which nobody was saying. Everybody's like, oh, we're going into recession, or they were saying, it's just going to go, we're going to come back. But nobody had this like weak first or strong first half, weak second half like you had. It's a great call there, Tommy. Jump into, this overall market and what you're seeing here now. Like, give us, your next call as we enter the final couple months of the year.
Well, I think what you said is exactly right. I mean, it's the toughest spot we've seen ourselves in a while. There is a lot of heavy selling. There's a lot of ugly charts. There's a lot of things like that. And as a technician, the last thing I really want to see is ugly charts. But at the same time, as y'all know, that's one of the main reasons I follow Brett in situations like that I follow it more from a standpoint of not really what to follow, but when you start getting to the washout levels that are basically the baby with the bathwater type analogies that are out there. And I do believe that we have a good opportunity that we're getting there based on some good technical levels that we've either just breached. And again, that's one of the things, the best technicians I've ever learned from and followed all that, they don't look as much at a hard line as they look at where is it 3 days later and maybe 2 to 3% from that level. Because breaking a line or breaking a particular point on a chart is easy to do. Zones are more important and looking more at kind of what the overall backdrop is. And I think you're right. I think people have gotten really bearish. And I think they've had good reason to for the last few weeks. I think this has been a good bit more precipitous than I thought it would be, but has been driven a lot by TLT and its drop as well. which again, no matter what the Fed does today, which I severely doubt they'll raise, it doesn't seem to me that would be a very smart thing to do at all right now. But at the same time, if they do either way, I think you've been setting up over the last week with some improved breadth, some improved things under the surface. It's really, as they say, it's really been the generals that have been really taken to the woodshed this week. And those are the ones that are really starting to, yeah, sure, we have the Paycom and that kind of stuff. But when you start seeing things like Tesla and Nvidia and some of these guys breaking heavy support levels, again, everybody's looking for that to be the start of something huge. And a lot of times that's kind of the end of it.
So what do you think for the last, like, we're going into the seasonally strong period for the markets? Ryan Dietrich, we've had him on the show, Ryan well, and he was saying typically the markets bottom October 27th, October 28th. I mean, holy cow, I'm looking at my calendar here. I'm looking what the market has done since literally 3 days ago. And I'm like, could Ryan Dietrich be right? Could he have called it on the day, October 27th? Could that be the bottom here in this market?
Well, this is one of the things I love about listening to y'all. And you were saying it just a minute ago on the Ackman bottom and this bottom and that bottom. And I know y'all are being playful in a lot of ways.
A little bit.
But at the same time, again, it's the what's happening for the next week or so around those things. It's not a day thing. It's the same things like everybody expects when you come off the bottom. Everybody's been saying this bottom's not necessarily good or strong or whatever because we don't have heavy volume. You don't have heavy volume off a bottom because people are scared. So the idea of saying that and that myth living for my entire career, and I still heard it this week. Oh, the bottom volume's still terrible. And I don't disagree, but you don't get volume until people start to buy in, not just physically with money, but mentally. And we're not there 2 days in. And I think that's something you have to respect. I agree with you completely. If we do find a seasonal bottom here, I don't know whether it's the bottom or not, but I've been talking with you guys for over a decade now about the fact is we get more information out of the bounce after a drop than we do out of the drop itself. Who engages? How much money comes back in? Where does that money go from a rotation standpoint? Is it defensive or is it more cyclical? Those types of things are going to give us a much better answer than what we saw the last week and a half as we get to, people talk about the rubber band stretching. We may not be there. I may be wrong, but usually when we get the rubber band stretches, you get to a point of reflexivity to where even if you do have a precipitous drop for a week or so, that is almost always zeroed back out within the next couple of weeks. And then the decision is made. Are we going to go back up or are we going to keep going down? It's usually not that spike that lasts very long.
Tommy, great point here. And one thing that we've been noticing about this decline is that there's been some moves in the VIX and everything, but it's just been like chunk. It's like chunk. Like they keep hitting it, but like the bids are there. And then, a little rally, then you come back again. It just feels like it was just such a maybe not the huge size, but it was like people were there. And then, like for Dennis and I, we like to see that whoosh. We like to see the washout and say, okay, big volume day back up, time to get in. It wasn't like that. So now that's in the past here, I like that you focus on the closing prices. And I think that people put too much emphasis on, the intraday stuff. So, give us some stocks that you're looking at or some ETFs and, what's a constructive move? What, where would, you need to see closes by the end of the day or the end of the week to say, yeah, man, maybe we did put a little bit more of a bottom in there.
Well, again, I mean, if you're just going with the overall indexes and all that, I mean, we certainly have to get further. And I don't know that bottom is going to come this week. It certainly can. And it does a lot of times when we have changeovers like the month or things like that. But it's usually, again, not that pinpointed like with Ryan Dietrich's dates, because right now we have a lot of news, a lot of ancillary things that are jumping out there as we're moving through this. But you are starting to see, and there are relative strength things that are shifting some that, you've got to be paying attention to. A lot of people wouldn't realize that financials actually have been up in the higher end of the sector rankings over the last few weeks. and everybody's talking so much about worrying about financials. Now you have to dig a little deeper and realize that that's more in things like insurance and more in things like some of the brokerage stuff and stuff like that over the banking and all that. But even regional banks have been one of the bigger movers over this last few weeks as far as relative strength. And so again, it's what do I need to see? I need to see the markets continue to build on what they're doing. I mean, I think if the Fed pauses and TLT can hold a gain today, that will help a lot into the close. That's going to help the markets, the stock market, more than it's going to help the bond market. But in that, and you're looking at that and you're basically working with those numbers, you're just now, like you said, the seasonality is coming into where after the persistence of the move down we've seen and seasonality coming in, I would expect it to have some reaction. And in that reaction, we'll figure out if it can last at all. But again, we're 2 years into this bear market overall.
Yeah.
So how much longer do you really expect it to last if you start looking at a lot of different historical standards?
This is what scares me the most, is what you just said, because some people think, oh yeah, we've been in a bear market for 2 weeks. I mean, you get outside that S&P 500 and those top 7, we've been in a bear market for 2 years. We just did the IWM. It's 34% off the all-time high. It's 2,000 stocks in there. You look at the RSP, which is equal weighted. That is down significantly from the highs. I don't know if it's 20%, but it's down. I'm just looking at the quick math. Not quite. 164, 135, so 30 on 164. Dang close to being down 20%. And at one point in time, it hasn't made a new high for 2 years. So you're right. We're 2 years into this bear market here. At a certain point in time, you got to say, well, man, there's a lot of bad news priced in. And hey, if 2024 isn't as bad as, maybe some of the bears think, maybe, just maybe, we should maybe start thinking about buying some stocks.
Well, I think you said the other day that you sold out of your long-term account. Hopefully you're just rotating and figuring out where the potential opportunity is, as opposed to just saying, some of these things are just to a point to where they aren't worth holding long-term anymore. That's a change in your mind. That's not just market structure. But at the same time, I agree. I think that is something we have to look at, is that some of these things, even the big names that we talk about are as strong as they are still well off their highs. Even some of our big, not the Magnificent Seven, but some of the other really large players out there in the markets, if you just go across their charts, this last year, even though we've been up and down, has not been pretty. And you hear all the statistics, whether it's Ryan or somewhere else, talking about, 50, 60, 70% of the stocks are down more than 20%. I don't know the exact number, but that's a lot with the market being up for the year. So this is one of those years that's really interesting, because that also with the side with real estate continuing to hold up pretty well on the residential side or the retail person side, that's putting a dichotomy in the markets, I think, that's getting us to an extreme to where a lot of people are getting worn out. Like Brian Shannon always says, is if they don't scare you out, they'll wear you out. And I think that's about where we're getting with the stock market right now, with real estate continuing to hold up the way it did, and everybody's thinking it's going to continue that way. Well, long-term high interest rates are not a plus for real estate. And we're starting to see the builders and some of these others come off as well and get outside of the actual public stock market. And a lot of the local builders and things like that are in much tougher positions. So I think you're in a position to where it's kind of that scenario. And I've seen it a couple of times in my career, to where people just get tired of stocks. It's just not doing anything for me. Whether they've lost all that much, it's that last, as it drops that last bit, even if it's just getting them back to where they were a year or two ago, they're like, I wasted 2 years. And that's just not a good way to look at the markets. They tend to work a lot in fits and starts.
All right, I'm going to come in here. I'm a little bit confused on saying that we never got out of a bear market when the Qs went up 44%.
No, I didn't. Again,
I just want to kind of clear that up there.
No, you certainly do. And the Qs did run out in that realm. And again, I'm not saying, I think we are in a new run. I don't believe that we're in a situation to where right now, I'm not seeing us rolling over at this moment. I believe the seasonality helps some, and then I'll see how that is taken after the Fed pauses. From that stance, though, you're exactly right, Mitch. That's a big run in stocks. But again, when you're looking at a larger scenario of the broad market, whether you're looking at the geometric index or whether you're looking at some of the other 3,000, Russell 3000, things like that, you have not seen a market that has moved that way. And I think that's a lot of where the disappointment is coming in, Mitch. You're right, that index ran. And that market was in a bull run. And I believe the broader markets are trying to get there. But I do not believe that we ever truly came out from a broad standpoint of the 22 downturn.
Well, Q's never made a new high. You know, there's one thing too, is to be said here is that the Qs topped out in 2021. We are 2 years later here. So as much as everybody can say the Qs have just been unbelievable, well, really, when you put it in perspective here, we are back to where we were in 2021. So, I mean, we have 2 years where the Qs, which is the best, the Qs are the best, have not made a new high. So it's, you could argue from, you know, a bearish perspective, even on the Qs, that, hey, you know, we still never made a new high. You know, so to start new bull runs, usually you need to make new highs.
Yeah, and I hate playing semantics, Mitch, at all, but I would almost say there's a difference in a bull run and a bull market.
Okay, I like
there
that.
you go.
Might be our separation.
100%.
I like
I'm
that
not
there.
trying to play semantics.
No, I like it there. And one thing that I would bring in is what will bring this next run? You feel that we're going into a run. Well, what's going to continue this run?
Well, I think there's two parts that could, but again, I'm not an economist and I'm not a real good macro guy. But when I look at where we are right now, the bearishness really is deep out there, and it's not just on the markets, it's on the economy in general. And the economy is not rolling over yet. And so the idea that we're going to run through with a very bearish economy or view on the economy and in the markets, if anything sparks their confidence out of that, like maybe the Fed's done. Because the one thing we can say here is a lot of people do, I think, see now that obviously our Fed and our government are not exactly on our side when it comes to markets and benefits and things like that right now. I mean, with the thing like the UAW strikes and all that and how that's being played and everything else, it's not a market favorable time at the moment. And I believe that's actually a lot of times when you do get your turns. Again, like I said, it's worn people out over the last 2 years.
Spinner making another point here too in the chat. Jay Rice we're referring to. Fed has a lot of ammo for the next 2 to 3 years now. I mean, this is something to think about here too. It's a point that Rogie Horner has brought in on our show. It's a point that we've made as well. It's hard to get super bearish here because the economy really does roll over. Imagine, okay, well, we're cutting 50 basis points. I mean, that was the driver. That was the driver for much of, you know, like 2015, 2016, 2017 was the interest rate reductions that we started getting that really brought us, well, even going back earlier than that, out of the financial crisis. I mean, it was quantitative easing that brought us out of the financial crisis. And it was, you know, lower interest rates that made that 10-year bull run happen in the S&P. And I mean, now we look at interest rates as high as they are and think, well, you know, if this economy really goes south and the bears are like, we were right, the economy's going south, the Fed has all these bullets to turn the economy around. So, I mean, I can't just go here and say we're going into a depression. We're going to have 10 years of down markets here because I think the Fed has so much ammo. Tommy, thoughts there?
Well, I hate to get political, but the problem is the Fed has so much ammo, but it's also being continued and being ambushed by the Treasury and Congress.
True.
I mean, the dumbest thing on the planet, I think Druckenmiller may have said it recently, the dumbest thing on the planet that ever happened was that they did not refinance long-term debt at 1 or 2%. That they kept refinancing 1 to 2 year debt. That was by far the absolute most ridiculous thing our government has ever done.
Yeah.
Because they could have refinanced 30-year debt at under 2%, and it would have changed this entire picture. Even if interest rates were 7% today, the picture would be a completely different one. So it's like every time the Fed feels like it has ammo, it's basically got to use that ammo against our own morons. And so it's unfortunate, but that's kind of where we are right now. The good part is we'd still have the most innovative and the most growth-based economy in the world, period. And so we've been able to overcome that many times before. I expect we probably will again. But that's why we have these just gargling times in the markets and just the sideways mess for years at a time, is because usually more than anything, the government just way oversteps its bounds. And then we have to figure out a way to either grow out of it or rein them in.
Yeah. Tommy Lackey Jr., managing partner and portfolio manager at Relativity Capital. Tommy, great information as always, and can't wait to get you back on again to give us a good insight into the markets. We appreciate you being one of our favorite guests, even though Dennis tells me not to say that.
Ha.
Thanks, guys. I really appreciate
Thanks,
it. Y'all
Tommy.
have a great day.
Take care, Tom.
Okay, the Bulls are still here. We are trading at the highs of the pre-market session. We are attempting to clear yesterday's high at 15.5. So, man, oh man, that TLT turned around on a dime. I got to look at it. I was looking at the bonds because I like to look at the 30-year bond a little bit more. And that is, I mean, if we could just clear 110 here, and I'm not just talking about on like a like the other day, we like went above 110 here in the bonds, probably equates to 85 in the TLT. But man, we poked our head above it 3 times in the last 2 weeks, only to get beat down again. We're at 109 and 24.30 seconds. That's what you see when you see it. You clear a resistance level, but not only is there, not only you clear it, that you make it a bid there. Now I don't know how many people are willing to, to make, a stand there at 110, but that's what I'm looking at it. Let me look at the TLT. I guess it kind of, boy, look at that. That Acma bottom keeps moving up here when I move the chart.
The weekly chart, I think, makes even more sense here, Joel. For some reason, I just like it. Just take a look at that. Look how you get this kind of double bottom off of that Friday week open 83.24. If that could just hold here, I'm gonna lean on that level.
I think so. I think you're leaning on that level in any purchases that you're making in stocks, not only bonds. So I think if you're coming in here, I think you can constructively try to play the seasonality, buying stocks here today, yesterday on dips. But I think you've got to have the short leash. And if TLT starts to actually break down and make new lows, I think you got to let some of those stocks go. So as a trade, I don't mind the setup here. Leaning on the TLT as your indicator, much like Derek said yesterday, much like Tommy, much like much of our guests, including myself, have been saying, is the TLT leading the bus in a lot of stocks. So keep an eye on that. We start to break down below 82 on the TLT. It's like, okay, I was wrong. I'm going to lose my 3-4% or whatever it was on these stocks. And, that's it. If I'm right, though, and we start to get, a turnaround here in stocks from a seasonality perspective, you could see, IWM move up in a hurry here. And, it's the money being made on some of these really beaten down names. And we're talking about, and maybe we can get into a few of them here, like Generac and stuff that are just absolutely destroyed. I mean, I was talking about seller exhaustion here. Mitch, can we go to GNRC? Because a couple people have asked for it. Obviously, I am still long GNRC. Not a happy long whatsoever, but, I am. I mean, this quarter wasn't great. Give us the numbers. It's not a great quarter. It's not great commentary. But here's stock still trading up 8%.
Yeah, adjusted EPS coming in here at $1.64 versus a $1.51 estimate. Net revenues of $1.07 billion versus $1.044 billion estimate. But they maintained their net sales guidance of down 10% to 12% year over year. One thing that I would say is I think the real question that we need to start asking ourselves is not necessarily, has the consumer already slowed down, but will they slow down in 24? Is the slowdown coming or has it already happened?
I think in certain pockets it has happened, and you can see clearly GNRC talking about net sales guidance. It isn't talking about lowering our sales guidance from being up 10 to 20% to up 10 to 12%. They're talking about sales guidance going down, like physically retracting. Less people buying. We know why. It's all these same reasons. This is a financing play. People have to finance these things. These generators aren't $500. Mine was $14,000. So I mean, these are financing plays for a lot of people. So again, if you're struggling with the financing, you're not getting 0% anymore unless you're buying an iPhone. I mean, that's an issue, and that's an issue for GNRC. The question is, has a lot of bad news already been priced in? I mean, I think so. The stock all-time high is $524. I mean, it's down here. They're making $1.60, call it $6. I mean, it's trading with a P of 12 or 14. That continues to go up, though, as the earnings go down. But more of the price action today, which is constructive, is that this quarter wasn't great. They didn't say anything about turning around. They said, if anything, it's still going to stay bad for 2020, the rest of 2023. And yet the stock is rallying 8%. So I think you're seeing some seller exhaustion in the stock. And for the simple reason, I mean, we have been just hammered, and I've taken the brunt of this, like obviously one of my very bad stock calls here. Bought it before we were worried about interest rates. As soon as long-term rates started going higher, you needed to sell all these stocks, and that would have been the play. ALB, GNRC, those bad stocks, like LTHM, those are the worst ones in my long-term portfolio, I think. And you guys know them. And, it would have been good. But at least the price action today is constructive. If you're trying to say that some of this stuff is just having seller exhaustion now, and maybe a lot of bad news is priced in.
Try to get up to $92. I have an area of interest here. Pre-market high comes in at 92.32. And then you just got a little bit of a gap area, 92.32 to 90.93. Wait, where's my gap? Right here. Yeah, there's a gap between 92.32 and 93.62. So looking for a little bit more on the upside, perhaps a gap fill there. I just a little bit too soon to be calling this a major bottom and be looking for a retracement. Top of yesterday's range, way down at 84.92.
Let's go to, there's a lot to get through here. Let's talk about CVS and Humana, and we can put these together because they definitely have a nice move, at least now starting to really fall off. This morning, it wasn't that bad when I looked at it, but yeah, this is falling off now. Humana adjusted EPS, $7.78, beats the $7.16 estimate. Sales also beat here. Fiscal year GAAP EPS of at least 26.31 from at least 26.91 prior versus a 28.3 estimate here. And that's why I think they're getting hit that estimate, right? They're saying at least 26.31, but not compared to that 28.3 estimate. Then also CVS. CVS beat, and they revised their guidance to $6.37 and $6.61 on the high end from $6.53 and $6.75 on the high end. So also revising their guidance down here.
Slightly down on the guidance on both of these stocks. Humana's in a completely different spot than CVS. Humana's not far from all-time highs. I don't totally get why, we've bought all these stocks back, UNH and Humana. I think it's just the defensive nature of the market saying, well, healthcare, obviously these health insurers, this is defensive because even in a recession, these things still have to make money because people still need help. They still are going to pay for their health. So that is true in the case, but the valuations aren't that attractive in here. I don't think I want to own these things at these prices here. CVS has been hammered, but I don't think I want to own drugstores either. I mean, we've obviously seen Rite Aid's been a disaster forever, but Walgreens can't seem to get a lift here. I feel like there's something else happening. I don't feel like I want to own CVS here either. Although I'll say if you're buying the dip on CVS, we're kind of in a buy the dip mentality the last couple of days, and you do have a low to lean on. $65. You're not far from that. So if you wanted to take a shot and say, hey, maybe they turn this around on it, I'd stop myself out below 64. So setting up a trade, you could buy it at 66.07 here. Well, 66.20 is the offer in the pre-market. I won't argue with you if you're doing that. It's not for me, but I do think I don't know if I'd be selling CVS in the hole here today.
Right, down 291. That's just been a magical level for the past couple months. Buyers stepped up again. You're getting a down open. That's easy. That's an easy one. The Humana chart, I don't know what this thing is. Look at the gaps in that thing all over the place.
And
now
it's they say Medicare news, and then it falls 7%, and then they forget about it, and then it goes all the way back up. Lots of things to think about with that stock.
Yeah, tough chart there. I'll take a pass on that one.
Match Group Q3 adjusted EPS 57 cents versus the 44 cent last year. Sales of 881.6 billion, beat the 881.07 estimate. Tinder direct revenue was up 11%. Hinge direct revenue up 44%. Match Group expects Q4 total revenue of 855 million to 865 million. But this is not why I expected, especially after you guys didn't see that guy on Tinder. I think I saw him. This guy, Dennis Dick, maybe out on Twitter. I'm just joking. Look at this one.
Let me see.
There you go, Dennis. You're out there.
What is that?
Your fake Tinder account, man.
Are you kidding me?
No, I'm messing with you, man.
Did you make that up, or
Yeah,
is it really one of
I
those
got
out
you,
there?
Dennis.
You made that
just
up?
Messing with you, yeah.
Oh gosh, I was like, there's fake Dennis sticks over there too. There's like a dozen of them on
The
Twitter.
funny part
I keep
is
trying to get rid of
the
them.
small text said at the bottom, looking for long-term investment, but looking to short.
No, is that what it says? Looking for long-term
Yeah.
investment, looking to short. That is kind of me. Stocks making a new low. The commentary is what did it here. I mean, the earnings were fine, but the Match Group expects a 2023 total revenue growth company-wide towards the lower end of the range it provided a year ago. You don't want to hear that. So it's the guidance knocking it down. I will say, this company does make money. I will say there's support here too. So we're just looking at, you can tell the mentality that I've got here changed a little bit here from sell the rip to a little bit of buy the dip, at least with the trading cap on. I'm not sure in the long-term investing hat, but definitely with the trading cap here. I got a little bit of the buy the dip mentality going on here. 30.73 is the low of the move. Can I hold it?
Yeah, trading down in the pre-market. Oh boy. Pre-market low comes in 31.20. Where are the lows here that Dennis just mentioned? 31.28. Got a little synergy there. I just, man, these stocks, I mean, these online, I don't get them. I don't know, what COVID helped them, hurt them, or whatever. But man, I don't know. It's a tough call on here. What's the other one? Bumble, like BMBL? Is that the symbol
Yeah.
on that one?
Yeah,
$13.
there's
All these things have been crushed.
Yeah.
Again, but bear markets everywhere around you when you look outside the Magnificent Seven. Bear markets everywhere.
definitely hit that like button. Let's go ahead. Let's do a little wrap up. What's your last thoughts on the markets, guys? And then we'll go to Joel for the ES outlook.
I think I'm still looking at the TLT before you start and go all in here on stocks. So it's leaking a little bit here. It's why the market has turned around and leaked. Keep an eye. It is driving the bus. Rates matter to the majority of stocks out there. Keep it out of the TLT. We're still in the middle of the range. So there really is no call to be made here yet. It feels like there's a buy the dip mentality in the last couple of days, but that's just feel. Technically here, the TLT is still right in the middle. So, it could go either way. Below 82, you don't want to own stocks. Above 85, you do want to own stocks. That's where we're at.
Okay, just keeping an eye on the upside. Yesterday's high, 15.5. We stuck over there in the pre-market, but faded a little bit. So I think it'd be a choppy two-way day ahead of the Fed. So everyone, have a good day. Back with you later on.
All right. Joel hopped real quick. I wanted to ask the guest for tomorrow, but he hopped for me there, guys. We'll wrap it up. Yeah, he's a quick one there sometimes. All right, guys, I'm going to bring you guys over to live
I got to go blow
trading.
my nose. I'm all stuffy.
I got to go fix my camera here. So have a good one, Dennis. I'll see you guys over on live trading. That's starting up next, guys. Don't go anywhere. I know I'm a ghost, but I'll be on live trading up next.